right. So,
Yeah.
Recording in progress.
okay, got it. Let me do, got it. Yeah. Okay,
Okay.
Um,
it's
Excellent. Uh, so here we go. So critical illness. So I remember years ago, when critical illness kind of first came on this scene, a person described it this way to me. She used the lottery um, kind of analogy. So she said, out there in the world, there are kind of like two lotteries. There's what they call cash for life, and then there's the 649. 649 is the lump sum. You win, you get a lump sum deposit. Cash for life is you win the lottery, but you get a payment every month. So what you have in your plan now is long-term disability, which is a little bit like cash for life. You get, unfortunately, something happens to you, you get sick, you're unable to work, you satisfy the waiting period, and you get a cash flow for as long as you're disabled.
or
That's
you're
long term.
disabled by the insurance company.
Correct. Yeah. So just so long as under the regular care of your physician, you're unable to do the regular duties of your occupation, they'll pay your claim. And then along came critical illness insurance, and critical illness insurance said, hey, here's a basket of illnesses that happen to people. If you get an illness and you survive 30 days, now this is why we're talking to Amanda, because survive 30 days doesn't apply with Allstate. If you got one of these illnesses, the big three are cancer, stroke, and heart attack. If you got those and you lived 30 days, bang, you got a lump sum payment. And that was critical illness. And they are different, right? Critical illness is different from long-term disability. There is a little bit of an overlap there, but they do provide great protection for people who have difficulties. So anything to add to that, Amanda? Is that a reasonable summary?
Pretty good high level.
Yeah. So what we're seeing lots, and I'm encouraging my clients to add critical illness to their policies. I also have clients who don't have long-term disability at all in their plans, and I think critical illness is a really affordable benefit for these organizations to take care of their employees. Uh, it can be actually less expensive than long-term disability, and it's a great way to take care of employees.
And Nick, I think I was looking for a quote in terms of dollar value, but I
Well,
was scanning through it. I don't know if I saw something.
I did send you a spreadsheet, with the employee census. I can bring it up and show you what the costs were.
Yeah, okay, because it did have, even though I tried to hide the name because of the job description, it did identify who's what, and some people.
Why don't I bring up you're interested in what it costs on a monthly basis?
Yeah, you don't have to bring that up anymore because
Oh, okay.
yeah, you could just tell me. Just bring it up on your screen, but don't show it on the recording screen.
Okay, fair enough. Let me just bring it up on my screen. I know Amanda's got it there,
That's fine.
but here, let me just bring it up. It'll just take one moment. MedTech, and then we had the
Yeah, I did delete that because I was gonna forward what you sent me. So that's why I
right.
ended up missing that part of it because I didn't realize
Okay.
that included
So,
the cost.
so what I have here is that, and there are different ways that it can be structured. So let's start with $50,000, which is what the amount of benefit that your organization would qualify for per person.
Is that cap? 50,000 cap lifetime?
No. When we get into the product features, one of the things I can tell you is that it's 50,000 per claim. So you can claim up to 19 times.
Which is
19.
which is
Yeah.
really unusual,
You got
frankly.
19 different diseases.
Yeah, and you can claim each condition once as long as there's 90 days between diagnosis. So 19 payments at 50K each. I can't do that math off the top of my head, but I know it's a big number with a lot of
It
zeros.
is a big
Yeah.
Yeah. So it's a serious benefit. So
Oh,
50,000.
just one more thing. So yeah, that's almost $1 million.
Yeah.
950,000.
Nobody's done it yet, but
So Nick, so just like get some clarification from Amanda. So Nick, you were saying that, let's say for example, someone was diagnosed with a disease, let's say cancer, because that's one of the main ones, and they survived. They survived for like 2 years, and everything went well. They went into remission, and then they're re-diagnosed. Can they claim again, or no? Can they claim multiple times for the same illness because you have a pre-existing illness, or no? Just a one-time claim.
you can only claim once per condition. So if they claimed cancer on our policy and we paid them, so it qualified, they got their 50K, check off, think of it as a checklist and check off cancer. Can't claim it again. Unless we do have an option where we have something called second event coverage, which would allow us to pay each condition twice. So if there's second event, if that's the option you guys choose, then if cancer reoccurs later than 12 months, so you need 12 months cancer free.
Okay.
And then if cancer comes back, you can claim again. But truthfully, if you have second event, every condition can be claimed twice. But let's use heart attack as an example. You can have a heart attack and then 2 months later have another heart attack, right? When we add on second event, the first heart attack, when it happens, put in the claim, get your $50,000. We tell you go get better. We need, though, for you to be able to claim it on our policy again 12 months later.
Yeah.
So if that second heart attack happens in 60 days, 90 days, unfortunately, for same diagnosis, we need 12 months. Different diagnoses. So say you have a heart attack, then a stroke, then a cancer. We just need 90 days in between each of those diagnoses.
It's very comprehensive coverage. Yeah. But you have to get your
Yeah.
head around it a little bit. So
A little bit.
Right. Okay. So just one more question. So let's take, for example, someone has cancer now, and we're just entering into the program. So obviously it will be a pre-existing condition. And then after we've signed up for the program, they're re-diagnosed with cancer. Do they get the coverage?
Okay. So
because they're coming in with a pre-diagnosed condition.
So yes, so we'll call it a pre-diagnosis, not a pre-existing condition, because we don't actually have a pre-existing condition clause. So let's look at something like diabetes, for instance. We know that a lot of people have diabetes. I think the statistic is 1 in 4 Canadians are living with some form of diabetes, whether it's actual or pre or whatever. 1 in 4 Canadians. So diabetes, we know, can cause a lot of other comorbidities. You can have blindness, coma, kidney failure, major organ failure, and also high risk for cardiovascular disease. So if there's a pre-existing condition clause on the policy, those people with diabetes are at risk of having their claim denied if they have blindness, kidney failure, heart attack, things like that, and it's somehow connected to that, which it usually would be, that diabetes. So we're not looking at the medical past to see if you had a pre-existing condition that's causing the condition you have now. But with cancer, because cancer can be really, I'm going to say annoying for lack of a better word, you can go in, get your diagnosis, you fight like hell to come out the other side. You do. Now, once you come out the other side and the doctor tells you, we got all the cancer, there's no more treatments necessary, you're in remission, go home, live your life. If it comes back, we'll figure it out, but go have a good day, right? That's when your clock starts. 12 months from that date, say you got our policy 4 months before that, whatever the case is, 12 months after that date, you're eligible to claim cancer on our policy if it comes back and you haven't.
It has to be 12 months.
12 months. That's our threshold of where we're comfortable saying you were cancer free and now it came back, we'll cover it. Other companies, and I know Manulife is one of them, they have a 60-month comfort zone. So if you had cancer before you bought the policy or whatever, even if you had the policy, they need you to be 5 years cancer free before you can even try to put a cancer claim through. Ours is 12 months.
Right. Okay.
Yeah.
So you talk about diabetes. You said that was an exception?
Well, we don't have a pre-X, so we don't look for your diabetes to see if the diabetes caused something you have now.
Okay. Okay.
Yeah,
Got it.
we have zero
Okay.
pre-existing condition clause at all.
Which is unheard of in the marketplace, quite honestly.
Yeah, I
This
just
is
thinking, do you guys have like an endless pool of funds?
Okay, so funny story. When I got this, well, when I was interviewing for this position, I'm going to be honest with you. I come from an advisor background. So I was working with clients all the time. I knew the products in the market. I had never heard of Allstate. I did not know what I was interviewing for. And then they start telling me about this product and I started learning about it. And before I accepted the job, I said to them, are you guys making money and will you be here for a long time?
Exactly.
Because how are you in business? You're paying probably so many claims. And an interesting thing is our industry, they hold this flag up in the air and they're so excited to be able to say that their decline rate on claims is 20%. They're excited about that. They think that's a great decline rate. 20% of their claims get denied. Ours is less than 5. So we're paying a lot of claims, and that's what you're really paying for. You're paying for a product that pays, right? But how we do it, and this is what they told me back then, and now I've seen it with my own eyes, is we need volume. So we need to be careful with the limits we give. So 50K is where we max out. We can't give you 100K because we're going to pay claims. So we got to be careful with how much we give out. So we scale back a little on that. We max out at 50K. And also, we need volume. So we're constantly putting lots of business on the books because it's like the Costco of critical illness insurance. You need lots of people to participate.
Yeah. Okay, that makes good sense. Good business.
Yes.
Yeah. No, it's very good. So one of the things I did bring up here is the spreadsheet with the rates. And what's I think very interesting is that for a single person for coverage, it's going to be $53 a month. That's for just, per month. So, however, if you want to upgrade to the second event coverage, it's only $57.43. It's only an extra like $4 and change. And Amanda was telling me, so that's the single rate. So I don't know how many singles and families you have in your organization.
Because this covers family members as well.
Yes. So here's the interesting thing is that if you have a spouse and you want them to be covered under the plan, we have to design the plan properly, but spouses qualify for 50% of the face amount if they get an illness. So if you want people to cover their spouses, they have to pay more. They go to $86 a month for the single and $93.36 for the second event. And the other thing that's important is kids are always covered for 50% of the face amount anyway.
Free.
So
free.
Yeah, they're free. They're covered anyway, all the kids. So the question is, do you want your spouse because here's the option is that you can set it up so that those who want their spouses covered, they pay the difference. So that's an option.
Okay. So you answered the question before I even asked it.
Yeah.
So for now, we pay staff and I represent both staff and employees. So I'm just gonna go staff pay for their own long-term disability so that they don't get taxed on it.
That's normal.
Is that similar in this case, or is it an organization that pays for the critical illness? Or what's recommended, Amanda? Are you recommending that individuals pay or that the organization pay? And is it taxed once they receive their pay?
Yeah. I mean, Nick, keep me honest. What I usually tell people, because he probably gets asked this a lot more than I do, but what I usually tell people is if you're going to pay for it as a company, roll the premium into as a taxable benefit, because you want to show it somehow as, you know, income tax to them, because you don't want it to be paid for with before tax dollars. Then they'll tax the benefit. You want it to be after tax dollars. So you either want
Yeah.
the employee paying for it, or you want to add the premium onto their income as a taxable benefit.
Yeah.
Uh-huh.
And it's a mandatory benefit. That's the other thing, is that if you add it to the plan, everybody gets it. And you either choose to pay for it as the organization, or you make them pay for it. I like it. I always, you know, it's a very tax efficient way to give people a bit of a bonus. Honestly, it's very tax efficient to give them this kind of a benefit rather than a bonus, than cash, because that's taxable. Whereas if you just pay for it as an organization and then add it to their T4, it's very efficient. Best way to do it.
Okay.
So
Good.
you're looking at on a single basis for the whole plan. For the single event would be $689 a month plus tax, which is 8%. And for the second event, for singles, it would be $746 a month, plus tax. And then if people, those of you who have, you know, spouses who want, they want their spouses covered, then I would suggest they pay the difference. That would be my,
One
I
little
like
thing.
that.
Yeah, but one little thing I want to add, we only charge single for the singles and family for the family. So even if you guys pick family, we're only going to charge family for the people that have spouses.
Right. Yeah.
We don't blanket it across everybody. I don't know. I think some companies do that because I get asked that a lot. But we don't do that.
No.
Yeah, we do
Yeah.
have some singles, not a ton, like the mostly families. Okay, I
Right.
like the idea of the employee paying for their spouses. I mean, it's the differential is not that much, right? It's
It's
about
not that
20
much.
something. Yeah.
No. You're
Maybe
looking at, yeah, if I knew what the singles were and the families were, I could, throw that into the spreadsheet for you to give you a closer
Yeah, that was
closer
exactly
idea.
what.
But, if everybody was family and you took the second event, you're looking at, just over $1,200 a month. So,
yeah, it's not a big difference. I was actually surprised when I saw it. I went, it's
yeah,
not a big price difference. But yeah, keep in mind, some of these illnesses you can't get twice. Like you can't go blind twice. You can't go deaf twice. You can't get Parkinson's twice or Alzheimer's twice or ALS twice. Like I'm just looking at the conditions. I have them on my wall. So
Yeah,
I look at
I
all these
don't.
conditions. You're not hitting them twice, but I'll tell you, cancer, stroke, heart attack, and coronary artery bypass surgery, our industry, that's 90% of the claims we see. So I think the additional premium really is for those 4 conditions, statistically speaking.
that's where the claims are for sure. Yeah.
And they just have to survive for 30 days, is that correct?
Nope.
No, that's the other thing about Allstate. Tell her how quickly you pay.
Okay. So we don't have a survival period. And so our critical illness becomes a form of quasi life insurance often because, listen to this, and if you've ever had to claim life insurance, this is going to really ding, ding, ding for you. So when you have a claim, you go into the doctor, you get diagnosed. And I'm going to first show you how it goes with a traditional company and then with Allstate. With a traditional company, you get your diagnosis. You have to wait 30 days to survive the diagnosis. Then you submit your claim form. Then the company is going to medically investigate you for the pre-X. They're looking to see if you had anything 2 years before you got this policy to see what's going on. So they got to do an investigation. We're probably talking 60 to 90 days before you get your CI payment. Reasonable amount of time. With Allstate, you go in and get your diagnosis. Then you get your test. So immediately get that test, the pathology test, the EKG, whatever it is, get it right away. Attach it to the claim form, send it to us immediately. Same day, next day, it doesn't matter to us. Do it as soon as possible. Takes us 3 days to adjudicate the claim, and then we set up a direct deposit into your bank account. So we pay our claims, we say within 3 days, because that's how long from when we get the paperwork to when we approve or deny. That's how long we're averaging right now. Then we're kind of at the mercy of the bank for the direct deposit, but still a lot faster than a check in the mail. Go to the bank, deposit it, wait for it to clear, and now you have your money. So we really found efficiencies in the process to try to cut the time down. So getting the payment to people that quickly and having no survival period, think of something like a heart attack.
Yeah.
I lost an uncle to a heart attack. Comes in wicked and it can knock you out the same day that it happens.
Mm-hmm.
Now you have to get your death certificate. Now you have to have the coroner's report, all this stuff. You got to send it to the insurance company, wait for them to do whatever they do to get your life insurance money. What, a month, Nick? 2 months?
Can
Sometimes
be, yeah.
it can take. So even your life insurance isn't coming that fast. But with ours, even if that diagnosis kills you same day, like a heart attack, get the EKG test, send it into us, 3 days to adjudicate, direct deposited into the beneficiary's bank account. So again, what are we looking at? 3 to 5 business days and the money's in your account. So again, faster than life insurance. You're still waiting for the life insurance at this point, but you have the CI money, make funeral arrangements, do what you got to do. You're not a GoFundMe, you know?
Yeah, no, that is awesome.
Yeah.
So here's a question that Nicole had asked because she's such a trooper. She worked right through, and she's saying, would we still get a payout if we continue to work?
Yeah, that
Yeah.
doesn't matter to us. Do
Yeah.
whatever you got to do.
Yeah.
I mean,
Yeah.
we'll always encourage you to take the time to recover.
Yes.
Because we know that pushing yourself to go to work can stress the body and obviously delay recovery. And that's kind of the point of our money, is to buy you time, right? So you don't have to work. But
And that's what I'm
work,
thinking. Maybe if she had that, she probably would consider it not working.
but you don't, I thought, did you guys not have CI through Manulife or?
No.
No, we don't. And
Okay.
but you know, it was a new position for her, president and CEO. So and
Yeah.
let's get the diagnosis right in the middle of that.
Well,
But
one of the
she
things
took herself. Yeah.
we used to, one of the benefits of critical illness insurance is you do get this lump sum, and that all of a sudden you can say, hey, I'm recovering at home. I would really like a family member to come. And then you just get them a plane ticket. Or, it's going to take me a while to recover. I, need some changes made to the bathroom, or, something, some
Or a
accommodation sort of
nurse,
a thing.
or have a nurse come in, right? To
Yeah.
come in
Nurse.
But you
Yeah.
know what? I was looking,
or a full-time housekeeper to come in while you're recovering your
Exactly.
from.
but I was looking at statistics recently because we've got partners within the industry and we're always looking for statistics that really pique up your ears. Do you know that in Toronto, so I'm in Toronto, it costs approximately $360,000 a year to be by the bedside of a sick child, between lost income, hotels, meals, all this stuff. Can you imagine the kid is sick and all you want to do is spend the time with your child? At least this money is helping somewhat, because if your child gets sick, there's $25K. Mom and dad can take a couple months off work, to be with their child.
No,
Yeah.
100%.
Yeah.
It's so good to have.
It's been a benefit that's kind of flown under the radar for a while, and I think it's really critical. I've been starting to talk to my clients who don't have long-term disability, but also other organizations that are interested in making sure that all their key people are covered, because that's, it also protects the organization. Like clearly in this scenario, we're wanting to protect the employee and their families, but it's also to protect the business. So.
Oh yeah.
Okay, the sick child was 38,000. I added a zero. I actually had the presentation open because it's top of mind, and I'm like, so 380,000 or it's 38,000?
Yeah, that's a big number still.
Still,
It
38,000.
is to take out of your savings.
Well,
Take a
lost
while to-
wages. Yeah.
Yeah, it take a while to recoup
Yeah.
that. And you mentioned about Manulife. We were presented with it. I think the last president we had, he probably didn't see the value. So, but now that we've had the experience where we've had someone who's had cancer with that, and it's a key person to the organization.
Yeah.
We thought, no, there's definitely value there.
Well, and it's always, after something happens that we start to think about this stuff. Even myself, I bought my first CI policy after one of my girlfriends got breast cancer. She was 29 years old, and I had it kind of floated past me being in the industry and doing, I didn't have my license to do this yet, but I had other licenses in the industry. And I remember sitting there going, she's got critical illness through her company. And she took all this time off, went and lived at the cottage, bought this cold cap thing, didn't lose her hair. It was breast cancer. So she told them, take them. She goes, I'll buy back better ones. I don't mind. And she did what she had to do. And she's with us today. We're now 10, 11 years later. So
Oh, that's awesome. That's good news.
yeah, it's one of those good news stories. And that was when I
Yeah.
bought my first, and guess how many I have now? I have 3. I became very enthusiastic, and now that's all I sell. So I went down a path of loving CI insurance once I saw firsthand what it can do for somebody.
Oh, that's a
Well,
very good
my
testimony.
brother has collected on CI insurance twice, 2 different policies, but he had prostate cancer 20 years ago, and then he had a heart valve done under a group policy. And he says the last thing you want to be worrying about is money when you're worrying already about your health. So
Yes, for
yeah.
sure.
The other thing I just wanted to point out, because you guys have brought up, you guys have cancer within your organization that you've dealt with recently. One of the things, especially with, versions, I guess you could say, or forms of breast cancer, some of them tend to be excluded on a CI policy.
Not yours.
Yeah, so I mean, you can beat yourself up about not having that CI policy from Manulife and would it have paid for your coworker and this and that.
Yeah.
You never know, right? Because a lot of times the definitions are so limiting in their language. It needs to be life-threatening. It must be your first occurrence. It must be after a certain waiting period, and all these things that language up and make it so hard to know if your policy or your claim's going to get paid. Just so you guys are aware, our definition of cancer, we have 2, and it's simple. We don't want to complicate things. We have invasive cancer and we have carcinoma in situ. Carcinoma in situ is a tumor within the tissue that is not growing and spreading. That's what our wording literally says. I mean, it's a little bit more sciencey, but it is a tumor within the tissue that is not growing and spreading. Invasive, and you get 25% of the benefit amount for that. Very minor cancer, very survivable, very low treatment, recovery, all that stuff. Still scary. Then you have invasive cancer. And the invasive cancer, our definition is a tumor that resides within the tissue that is growing and spreading and invading neighboring tissue. So it's not stage 1, 2, 3, T1B, all this complicated stuff. Is it sitting still or is it moving and growing? If it's moving and growing, you get the full 100% because you're going to war. You are having a full-fledged fight and you're going to need that full benefit amount. But if it's carcinoma in situ, we're not leaving you high and dry and saying, easy, you could kick that. You don't need our money. We're still going to give you a payment. It's just a reduced payment and it doesn't affect any of the other payouts. So if down the road you end up with invasive cancer, that's a new diagnosis. If the carcinoma in situ turns into misdiagnosed, whatever the case was, and it turns into an invasive cancer, that's a different cancer. So now it's a different claim.
That's interesting. I'm so glad we're recording this.
Yeah, I know. I always used to just try to keep it simple, but it is, there are lots of details. The way I try to keep it simple is, there with the Allstate plan, there's 19 illnesses. If you get one, and the big 3 are heart attack, stroke, and cancer, you're going to get a lump sum.
Yep.
But there are details that we do need to talk about. So.
Oh no, that's good. That's good information. Is there anything else that I need to know regarding this?
I think we covered my big ticket items. I'm just thinking off the top of my head. I always have I have our chart, the things we cover. I mean, the policy is portable. That's probably the only other thing.
Oh, that's the other. Yeah. That's worth talking about.
Is portable meaning?
Take it with you. Nothing changes. The only thing that's going to change is the premium, truthfully. I always like to be transparent. So you would just let Nick know, hey, so-and-so terminated from the company. He'd contact us. We would reach out with a portability form and a payment form. And if
So
Yeah, if they
someone
want to
is
take it with
retired,
them.
is there an age limit? I'm sorry, Amanda. I just get excited and jump in.
No, there's no termination age quoted. So the rates Nick's giving you, there's no termination age on that. So this is going to cover them. Okay, I make the joke because we have rates that go to the age of 99. If somebody makes it to 100 and they still want this policy, we'll strike a deal. We'll come up with a price. But our prices only go to 99. I think statistically speaking, not a lot of us cross 100 and it can still afford the premium for things like this because once you port the policy, so once you jump out of the group and you're set up on your own, you don't get that $53 or the 80 whatever dollar.
Yeah,
You don't get that rate anymore because you're not part of the group. So
the
we
rate
have
is
to
much
rate
higher.
you individually. So
Yeah.
then you go into our age banded rate tables, and they're 5-year age bands. Your premium stays at that rate so long as you're in that age band. Once you jump up, your rate would jump up. And as you get older, it does become a little bit cost prohibitive unless you have the finances to, keep up with the premium. So they kind of naturally eliminate themselves when they get into their like 80s and 90s. So that's
Yeah,
we don't really worry about, if you're 100 years old, we'll still pay for you. But there's probably people out there that would love to pay the premium and keep the policy, right?
of course. Okay, so this is good to know. Yeah. Yeah, I'm glad to hear that it's portable that
I
way.
think the other thing as well is that, if somebody were to leave and they said, I want to maintain my policy, I would have a conversation with them and say, okay, well, let's have a look at it. Maybe what we need to do is if you're young enough, maybe we need to just get you your own individual policy with another insured that will maybe not have all the bells and whistles of the Allstate, but might give you a level premium. So
Yeah.
that's the other way to do it. So, but we could,
You weigh it then, see
pros
what
and cons.
differences you're
Yeah.
getting, our price.
Yeah.
I can tell you though, well, I'm in our voluntary age band. So Allstate ourselves, we offer it to our company on a voluntary basis. Whoever wants it takes it. And most of us take it because we see the value in it, right?
Right.
But for myself, I'm about to cross up an age band. But right now I pay, I think, $10 a month for 30,000 in coverage based on my
Oh,
age. I know
yeah.
that's a big difference for your group, but we average out, basically you look at the demographic, everybody gets put into buckets based
Yeah.
on their age and gender, and each bucket has a weight that goes towards the premium. So on your
Right.
renewal, if everything stays exactly the same, the only thing that we have to worry about is that everybody would have aged up 2 years because we have a 2-year
Yes.
guarantee.
Yes.
So you likely could see your premium go up. It depends where they sit in the bands because it is banded as well, even on our employer paid.
Mm-hmm.
Increase, it's literally demographic driven. It is not us playing with rate or doing anything wonky. We don't do that.
Well, for those who understand group, and see that their life rates are going up and their LTD rate, and they kind of get that. The older you get, the more expensive it gets. So
Yeah.
Everything's more expensive when we get older.
yes,
Unfortunately.
Yeah.
except the GO train. If you get a senior's rate, there you go.
Touché. And Shoppers Drug Mart, isn't it Tuesday?
That's right. At
Senior rate?
55,
At 55?
My
at
mom loved that.
55, you get seniors rates. Yeah.
Where? At
Shoppers Drug
Shoppers.
Mart.
55. Okay.
Yeah.
I
All
remember
right.
that.
There are some perks.
There are some perks. Yes.
So thanks a lot, Amanda. I really appreciate that. Maybe Nick, if I could just talk to you for a few minutes, because you
Okay.
requested something that I just wanted to address and
Okay.
talk to
Yeah,
you
we've
about
got some
that.
other things cooking. So
Yeah,
we'll say
and
goodbye
then
to
maybe we can
Amanda.
stop the recording. Thanks so much, Amanda. I really appreciate it.
Thank you. No
Okay.
problem.
You're
Have a good one,
welcome.
guys. Bye.
Okay.
Bye.
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 And you're still there.
Yes, and if you can stop the recording, this is just